Welcome to our presentation today on the Structural Analysis of FX Intervention 2026. We'll be taking a deep dive into the yen defense war and providing a strategic investment outlook. On April 30th, we witnessed what we're calling the live bullet shock, characterized by an estimated 5.4 trillion yen liquidity drain. Massive Japanese yen buying was triggered after the yen hit a record low of 160.73 per US dollar. A discrepancy in the Bank of Japan's current account data strongly suggests this significant scale of intervention. Authorities strategically targeted low liquidity offshore hours to maximize the rate impact per yen spent, and in doing so, forced a remarkable 5 yen rebound in just a few hours. Following swiftly on May 1st, we observed what we've termed the wave attack follow-up. This was a clear act of strategic deterrence, ensuring that the April 30th move wasn't a one-off. It established a pattern of relentless pursuit against currency speculators. This also led to reinforced selling, pushing the USD-JPY pair back to 155.50 levels from 158.00, significantly increasing the carry trade risk for short sellers. Furthermore, the no-comment policy from Vice Finance Minister Mitsumura has created a psychological war, effectively maintaining market anxiety and uncertainty. The authority rhetoric underwent a significant shift, transitioning from mere words to physical action. As Vice Finance Minister Mitsumura and Minister Katayama stated in April 2026, "Consider this our final evacuation notice. The time for decisive action has arrived." This explicit shift from monitoring to wartime terminology clearly signaled the end of simple oral intervention and marked the beginning of aggressive, tangible liquidity intervention in the market. Looking at the period post-intervention, particularly around the April 30th major intervention and the May 1st U.S. jobs report, alongside the FOMC's rate decisions in the 3.50 to 3.75% range, we see a crucial dynamic. Strong U.S. labor market data continues to exert upward pressure on the U.S. dollar. This ongoing strength directly tests the effectiveness and sustainability of the Bank of Japan's JPY support efforts. To anticipate future interventions, we've developed a framework for estimating timing and triggers. First, in terms of price level, a critical threshold for USD-JPY reaching 161.00 to 161.95 indicates potential intervention, and this risk is active 247. For volatility, intraday moves greater than 2 Japanese yen, or a rapid multi-yen crash, particularly after CPI or jobs data releases, are key indicators. Regarding the environment, periods of thin liquidity, such as early mornings, holidays, or during Golden Week and weekends, present critical warning periods. Finally, exogenous factors like a spike in oil prices or the U.S. 10-year yield exceeding 4.5%, often triggered by geopolitical events, are significant triggers to watch. We must also consider what we're calling the Warsh effect, a potential new catalyst for yen movements. This refers to the hawkish succession risk, particularly if Kevin Warsh, a potential FRB chair successor, were to take office. He is known for his strict anti-inflation stance, which could lead to a policy shift towards higher for longer, thereby delaying expected rate cuts. This political transition would likely create short-term USD strength, further complicating Japan's efforts to defend the yen. Beyond immediate interventions, we face significant structural pressure from oil prices and the resulting deficit, which we term the exogenous enemy. Rising Middle East tensions consistently drive oil prices upward, directly worsening Japan's trade balance and creating an organic demand for JPY selling. While intervention acts as a speed brake, the underlying structural trend remains biased towards 170 Japanese yen per US dollar, unless we see a substantial decline in US yields. Moving to actionable strategy, we've identified some JPY strength picks. Nitori HD, ticker 9843, has a high import ratio for home goods, making it a direct beneficiary of yen appreciation through lower costs of goods sold and improved margins. Similarly, Kobe Bussin, ticker 3038, the operator of Guillaume Super, also has a high direct import ratio, ensuring cost competitiveness during phases of yen recovery. Additionally, for defensive rotations, consider SoftBank 9434 and Japan Tobacco 2914 as potential safe havens. For strategic foreign asset hedging, especially within NISA accounts, balancing currency risk is paramount. We recommend utilizing FX-hedged versions of S&P 500 or all-country funds. This strategy, aiming for about 40% hedge, effectively protects your portfolio from valuation drops that can occur during sharp Bank of Japan interventions. While there are costs associated with hedging, these are fully justified during high volatility warning phases to preserve capital. To secure income, we highlight opportunities in J-REITs and banks. The Industrial Fund, ticker 3249, offers an attractive yield of approximately 5.3%. Its focus on logistics infrastructure makes it particularly resilient against currency volatility. Among mega banks, Sumitomo Mitsui, or SMFG, ticker 8316, stands out. Its revenue growth is strongly tied to domestic rate hikes, and it offers around a 2.8% yield. Lastly, Daiwa House, ticker 8984, with a yield of approximately 4.8%, is diversified in both housing and logistics sectors, backed by strong sponsors. Now, let's discuss what not to do. Avoid high leverage counter trading. With a maximum survival time of potentially just 24 hours at 25x leverage, the risk of instant liquidation is extremely high. Interventions frequently trigger severe liquidity gaps, meaning your stop losses may not execute as intended, leading to significant slippage. Betting on the exact timing of an intervention is essentially high-risk gambling. Furthermore, full recoveries, or V-shaped bounces, can wipe out delayed exits and entire positions in a matter of minutes. Continuing our warnings, please avoid overtrading and cost averaging down. First, we strongly advise against nanpin, or cost averaging down. Doubling down on a losing position directly against an intervention wave is a recipe for total capital loss. Secondly, beware of poji disease, or overtrading. Viewing every small fluctuation as a trading opportunity inevitably leads to emotional burnout and unnecessarily increased spread costs. Lastly, exposing full leverage, being all in during thin markets, essentially makes you the primary target for authority liquidity sweeps. Another trap to avoid is late entry into foreign-denominated insurance. Remember the "Shushine boy" signal when mass market sentiment shifts to buying dollars. At what appears to be the peak, a reversal is often imminent. Foreign-denominated insurance, by its very nature, lacks the flexibility to exit quickly or strategically during rapid interventions. The combination of early termination penalties and potential currency loss can lead to permanent capital impairment. To navigate these turbulent markets, adhere to these golden rules of risk management. First, implement the 5% absolute rule. Strictly limit your exposure so that no single trade can lose more than 5% of your total capital. During interventions, survival of your capital is the absolute first priority. Secondly, practice emotional detachment. Treat your stop losses as tactical retreats rather than defeats. This mindset helps eliminate destructive revenge trading and encourages you to ignore unverified rumors circulating on social media. In conclusion, and for your guidance, remember that discipline is your only shield against the market waves expected in 2026. We recommend a three-pronged approach. First, employ low leverage and utilize hard stop losses to protect your capital. Second, rotate your investments into JPY benefit stocks that can profit from yen appreciation or stability. And finally, strategically pursue long-term global diversification to build resilience and capture growth beyond the immediate currency fluctuations. Here you will find the sources for the various images used throughout this presentation. And on this slide, you'll see the remaining image sources.